All right. Hello, everyone. Welcome to NCSL's webinar, Insurance Protection Gaps, a Primer for Public Policymakers. My name is Heather Morton, and I will be introducing the webinar today. I am a program principal with the Fiscal Affairs Program, and I staff the NCSL Task Force on Insurance and our Communications, Financial Services, and Interstate Commerce Committee. Today's webinar is a platform for information exchange and engagement. Over the next 60 minutes, we encourage participation through our chat box, so feel free to type your questions and answer any questions in the chat box, which is in the lower left hand of your screen. To begin building some comfortability with the chat function and to also learn who is on the line today, I invite you to type in the state from which you are calling now. I want to briefly mention the resources that we have available. Above the presentation, you will see a couple of tabs with one of them is labeled as Resources. Here you can find and download a PDF version of the PowerPoint. Another tab is labeled Speaker, where you can read the bio of today's speakers. You can access these tabs at any time during the presentation. Today's webinar is being recorded and will be available on NCSL's website within the week. As a heads up, there will be a quick survey at the end of the webinar that we ask you to complete to help us with future planning. Now, I would like to turn to our moderator, Frank Tomasello, with the Institute's Griffith Insurance Education Foundation.
Thank you, Heather, and hello to all. We appreciate your joining us. The Institute's Griffith Foundation is pleased to collaborate with NCSL and values its collaborative relationship with NCSL. So it's a joy to co-present this webinar. For those unfamiliar with the Institute's Griffith Foundation, let me note that Griffith serves public policymakers and their staff members by providing nonpartisan, non-advocative programming on the fundamentals of insurance and also on emerging risk management issues. In keeping with our mission, today's program is strictly instructional in nature, and it does not support a position on any issue. It's a true pleasure to welcome to our microphones today Dr. James Hilliard, Associate Professor of Instruction in the Department of Risk, Insurance, and Health Management in the Fox School of Business at Temple University in Philadelphia, Pennsylvania. Dr. Hilliard's research is focused on capital structure, capital markets, and regulation in the insurance industry. He also publishes case studies and pedagogical notes for both the insurance and finance classrooms. Among other outlets, he's published in the Journal of Risk and Insurance, Geneva Risk and Insurance Review, Southern Economic Journal, and the European Financial Management. Jim, thank you so much for joining us, for sharing your expertise on this very interesting topic of insurance protection gaps. There is much ground to cover in the 60 minutes ahead. Where do you suggest we start?
Good afternoon, Frank, and thank you for inviting me to be a part of this webinar. What I would like to start with to begin, I'd like to point out something that our former Secretary of Defense said that I thought fit really well with the topic of gaps in insurance. You might recall this quote. I've heard it many times in many different places, but I think it particularly fits in this discussion. Donald Rumsfeld said, "There are known knowns. There are things that we know we know. We also know that there are known unknowns. That is to say that we know there are some things that we do not know. But there are also unknown unknowns, the ones that we don't know that we don't know. And if one looks throughout the history of our country and other free countries, it is the latter category that tend to be the difficult ones." Well, Secretary Rumsfeld at that time was talking about the war in the Middle East, but I thought that that also made a good segue into the things that we can talk about with the insurance industry. And it's always a pleasure for me in particular to talk to legislators, because legislators really have in front of them the task of making sure that their constituents have all the tools that they need. And in some ways, it becomes the task of the legislator to identify what those unknown unknowns are so that they can help the constituents when they have needs and run into problems, and also to make sure that the tools are available for them to identify the places where they are not covered but might think that they are. So let me first of all, as a part of the background, I'd like to talk about a few of the known knowns so that we sort of have a level set for the things that I think most people who have any awareness of insurance or go through the process of buying policies or own homes or automobiles, they kind of know that certain things are covered. It's pretty clear that fire is a covered risk if you have homeowners insurance, and that theft of goods in your home or theft of a vehicle would be things that are covered under an auto or home policy. I think there's a somewhat decent working level of knowledge about what liability issues are covered, although I think we will talk about some of the areas where we're not clear, or I think where consumers are not always clear on what liabilities are covered and where there are gaps. And most people are aware that if there's a hurricane, that the wind damage from the hurricane is covered, but they may also know that flood's not covered. And so talking about the known knowns brings me sort of into the area of known unknowns. And when I say known unknowns, it's not that we know we don't know it. It's that we know that there are certain things that are not covered, and our constituents or our policyholders may not know how they're going to pay for them. So arson, especially if it's first-party arson, the policyholder that burns their own home down is probably not going to be able to file a successful claim with their insurance carrier. With a few exceptions like an extended warranty or a home warranty, maintenance items are usually not covered. And there are reasons for that. We know what those expenses are going to be, and they typically are not large expenses, and they can be budgeted. And so maintenance is usually something that is not covered by an insurance policy, and nobody's going to be surprised by that. That's why I say it's a known unknown. While we're not surprised about it, we also are pretty clear that we may not know how we're going to pay for it. Intentional damage obviously would be excluded. It would be silly for an insurance company to write an insurance policy that would pay for damage that a person caused that was not by accident. And then I think people who watch the news or read the press are pretty aware that flood damage and earthquake damage is usually excluded from insurance policies, although from time to time that comes as a surprise. I know that there was, in the wake of Hurricanes Katrina, Rita, and Wilma that blew through the Gulf Coast in 2004 and 2005, there was I think some confusion among policyholders about what actually was or was not covered under flood policies. And our federal government has made a way for flood damage to be covered, and the states where earthquakes are prominent, in particular in California, earthquake coverage is also made available, but they're usually excluded under standard insurance policies. So when I say known unknowns, it's not that we don't know that we know that they're not there, but we don't know how we are going to pay for them. So that brings me to the third category, which I'm just going to kind of slide by, which is unknown knowns. And Secretary Rumsfeld did not mention these, but to make the circle complete, these are the kinds of things that we know without even thinking about it. We know how to breathe, and at some level we even know how to drive if we've been driving for a while without thinking about it. And we don't even know that we know how to do these things because it comes so naturally. So I'm not going to talk about those in the insurance context, but I'm going to spend the rest of the time today talking about unknown unknowns. And I have a list on the screen here of the specific areas I'm going to go into today. And if you're going to join with us in Phoenix at the live event next week, I'd like to be able to drill down into a few of these at some level of depth. And hopefully we will take away from the webinar today some guidance about the things that would be of particular interest. Or if there are things that we don't cover today that would also be of interest, then we can we'll let the sponsors know, and we'll make sure that we include that on the agenda for next week. So I'm going to spend some time today talking about insured value, liability limits, how uninsured motorist coverage applies and doesn't apply, threats that our policyholders and constituents face with respect to cyber risk and identity theft in particular. I'm going to talk a little bit about how homeowners policies may not address issues associated with home-based businesses and home host businesses like Airbnb or vacation rental by owner. We'll talk about Rideshare, which has become a fairly prominent topic in the press, but a lot of people are downloading apps and starting to drive without maybe a full awareness of what their auto insurance policy covers. There are some new risks that have emerged in California in particular and other parts of the Southwest with respect to wildfire. Not that wildfire is an unknown with respect to coverage, but policyholders are finding themselves with non-renewal that they didn't expect. And then the final category that I want to cover, which actually applies beyond insurance and also to payroll taxes and things like that, applies to domestic employees. But I'm going to focus in particular on the insurance issues associated with domestic employees. So we're going to go through these, but before I do that, I wanted to spend just a few minutes talking about what a protection gap is. And I'm going to say at this point that I'm indebted to Professor Jay Feynman at Rutgers University, who sort of put these categories together in a nice white paper that is on his website. I found that very useful as a way to think through these things. A protection gap is the difference between the amount of insurance that's in place, that is the amount that an insured could recover in case of an accident, and the amount of insurance that should be in place. And when we say should be in place, we're kind of referring to what would be socially optimal. The first is that insurance is available, right? Whether there's actually insurance available for a particular risk or not would be a question that some people may not even be aware of. The second is that the insurance meets the policyholder's expectations. And this becomes tricky because if you've ever had a chance to resolve your insomnia issues by reading an insurance policy and as you're getting ready for bed at night, this seems to be about the only good use for it unless you're actually someone who thinks about insurance all the time. But without reading a policy in detail, it's often a surprise the things that might not be covered or things that might be covered. So even if we know that floods are not covered by certain insurance policies, the certain types of flooding, including sewer backups, might be covered, and a person really needs to look at the policy to know what that is. But they may expect one thing and then find out after a loss that something else is actually true. That would be a protection gap. The third is that the risks covered are insurable. The fourth is that the insurance is economically viable. And then finally, that insurance provides positive social benefits.
Jim, it's Frank Tomasello wondering if you might speak a bit to the factors that make risks insurable for the benefit of our attendees, and perhaps maybe the factors that make insurance economically viable as well.
Sure, I'd be happy to. In order for something to be insurable, it has to be the type of risk that an insurance company, or really any counterparty, can reduce the risk by putting a lot of different risks in the same pool. So you might say that automobile accidents are insurable because there are a lot of people driving vehicles around at any given time, and not all of them will have accidents at any given time. So that's one of the things that makes risk insurable, is that there's the law of large numbers applying, and that you have a somewhat predictable, even though each individual incident is maybe not predictable, the aggregate loss associated with a particular type of risk is predictable. Also, that the risk is somewhat homogeneous. In other words, that we have a whole lot of vehicles that are roughly the same size driving around, so that we can actually figure out what the expected loss would be on average for each of those. And then in a separate category, we might have the number of large trucks driving around and treat those as a risk pool. So for a risk to be insurable, it really has to have a large pool that's homogeneous with a predictable level of losses. By the way, after the September 11th attacks, insurance companies pretty quickly ruled that terrorist acts were suddenly uninsurable. And the reason that they said that is that suddenly all predictions about what the damage from terrorist attacks could have been sort of went out the window, because we had never really experienced a loss of that type or that size with respect to terrorism. Another factor that makes a risk insurable is that the loss is fortuitous. And when I say the loss is fortuitous, what I mean by that is that it happens by accident, and it can neither be caused nor predicted explicitly by the policyholder. And the third factor that makes a risk insurable is that it is not catastrophic. In other words, it doesn't affect everyone in a large region at the same time, at the same level. Because if it was a catastrophic risk, and here's where we talk about earthquakes and floods, it would basically wipe out all of the capital that an insurance company or any counterparty had set aside to cover it. So those are really the three factors that I think drive, although there are others, those are the three key factors that drive making a risk insurable, that they are homogeneous and predictable by a pool, that the risk can be pooled according to the law of large numbers, that they are fortuitous, and that they are not catastrophic. Now that brings into another question about what makes a risk economically viable. Economists who talk about information asymmetry, or the fact that insurers have different information than policyholders, would suggest that there are two factors that can make insurance no longer economically viable. One is moral hazard, A moral hazard in a classic sense is that when one person is not watching someone else, the second person has an incentive to do things that benefit themselves. That's a classic, very generic definition, but when we talk about it in terms of insurance, you might say that a person who has insurance might have less incentive to take care if someone else is footing the bill. I'd got a much larger conversation when I talk about health insurance, but that's sort of beyond the scope of this discussion of how the presence of health insurance might change someone's behavior with respect to taking care of their own health. With respect to auto insurance and homeowners insurance, I think people fully recognize the impact of deductibles and limits and the possibility of price increases so that they actually do something to protect their own property, even though it's insured. Although a moral hazard can never be totally eliminated, even in those cases. The second impact of information asymmetry is adverse selection, and this is actually much more prominent in the types of insurance that we're talking about here, those insurance protection gaps that our constituents often face. Adverse selection is the idea that if an insurance policy is priced given an average loss, people who know what their own risk level is will choose whether to buy insurance or not. People who are of low risk will not buy insurance because it will look overpriced to them if they know what their risk level is, while people who are of high risk will certainly buy insurance because that insurance looks cheap. So what happens as a result of adverse selection, if the insurer can't figure out which is which, they have to charge the highest price to make sure that that they don't lose more than they should lose. Then the result of that is that only the people of the highest risk are willing to pay the highest price, and they're the only ones who will get insurance. And that then would violate the fifth category here, because now we're no longer providing the social benefits of insurance to people who are of low risk but could still benefit. The third factor that makes insurance economically viable is that the insurer is able to charge a viable premium. And again, looking in the healthcare market, we see that health insurance for many individuals is now rising beyond the level of affordability, which then calls into question whether the health insurance system that we have right now is sustainable, given the fact that insurers are having a more and more difficult time charging a viable premium. Again, beyond the scope of this conversation, but if you read or follow the press or reports from your constituents about the cost of health insurance, it's becoming evident that there may need to be some action taken with respect to health insurance premiums to make them more available to people. So those are a deeper dive into the questions of what makes risks insurable and what makes insurance economically viable. So given the presence of these protection gaps, I want to look at 5 categories of protection gaps. We're going to spend most of our time on 4 of them. The fifth is the claiming gap. And the claiming gap is the one that we won't spend much time on because it's less focused on the availability of policies and much more on the difficulty of filing a claim. So we're not going to spend, none of my examples actually fall into that category, although there are examples that we could talk about within the claiming gap. So I'm going to focus on the other 4. We're going to spend some time talking about places where people are entirely uninsured and may not realize it. We're going to talk about places where people are underinsured, where they don't have the amount of insurance that might be socially optimal or that they may even think that they have. We're going to talk about the risk protection gap, where there are holes in their insurance policies that are not providing the protection that they would think that they need for certain types of coverage. The coverage gap talks about places where the coverage is either not available or not provided within the insurance company. And so we're going to talk about different examples in those 4 areas. So the first is insured value, or the part of the underinsured problem. The insured value comes from the fact, looking primarily at a homeowner's policy, or maybe even a renter's policy for the contents of the apartment. The replacement cost of a home is estimated when the policy is first incepted. I recently purchased a home here in the Philadelphia area, and when I bought the policy, I spent some time talking to several different insurance agents who used a computer model to determine what it would cost to replace my home. And so we wrote a policy that was based on what the expected cost to replace the home that I was buying would be, one that was higher than the amount of the mortgage that I was taking because that's what the bank required, but then I wanted protection for myself for the amount of equity that I was going to hold in the home as well. That happened at policy inception. However, policies are renewed typically annually for homeowners policies, but the replacement cost is not necessarily updated. Furthermore, people may write their policy for a certain value. It's usually a percentage of the insured value of the home for the contents of their home, and that may not accurately reflect the replacement cost of the contents of the home either. So when the replacement cost is not updated regularly, it's possible that the actual payment from the insurance company would not meet the expectation of the insured. According
Jim,
to CoreLogic, yeah, go ahead. Yeah.
Just wanted to jump in and ask, could you help us to understand how replacement costs are determined? What does that process look like?
Yeah, so when I was buying the house, my house is about 80 years old, and it's the kind of home that is just not built anymore. So when I worked with my insurance agent, they plugged the information about my home into a model in their computer, which said that if they were to replace my home, building a home exactly like it in the neighborhood where the house was built, then it would cost a certain amount of money to rebuild that home. Now, given the fact that few people use those tools or the equipment or the materials, it would actually be a whole lot more expensive than the home is actually worth. So the house is, in this case, is actually insured for more than the market value of the home, which doesn't make any sense, right? And so we decided to write the policy with a replacement cost that covered the mortgage and our equity and a little bit more, so that we could replace it with a house of equal value, although it may not be exactly the same kind of house. Now, if we look forward 10 years perhaps, the cost to replace a house exactly like that or to buy a house at market that was like that home might be very different. But if I hadn't revisited my policy with my agent, my policy might not be updated to reflect that. And so as the cost of the housing stock changes over time, the replacement cost that's stated on the policy, which is the maximum amount that a person can get, is probably not going to keep up.
Thank you, Jim. Very helpful.
According to CoreLogic, which is a company that researches these things, 3 out of 5 homes in the United States are currently underinsured by at least 20%. So you can imagine that if your home was the subject of a fire and was deemed a total loss, and you had a replacement value built for the home stated at $300,000, and then received a check for $300,000, part of it, of course, goes to your lender if you have one, then you find yourself going to the market and now being able to afford a house that's 80% of that size and maybe in a less desirable neighborhood. That would be the result of being underinsured with respect to replacement costs. And similarly for contents, if your contents are insured for 10% of your replacement costs and you actually have contents of your home worth 20% of replacement costs, you'd find yourself in a position where you couldn't replace the contents of your home back to the standard of living that you and your family had become accustomed to. Another example of underinsurance that sometimes catches people off guard is that in the past, people with homeowners policies were typically writing by a standard about $1,000 deductible. But insurance premiums for homes have risen with the cost of homes and the real estate increases we've had over the past 30 years. That means that insurance bills are suddenly looking more expensive because they're covering a larger potential level of loss. And so one of the ways that insurance companies try to make their policies look economically viable by charging a viable premium is to adjust the deductible. Now, I could spend a couple minutes talking about how deductibles work to reduce the price of policies. That is that if you have a $1,000 deductible, and now all the little $500 or $600 property losses that you might have from a shingle tearing off or a shutter falling off or something happening to a window, baseball going through a window, if an insurance company can eliminate all of those claims, then they reduce their expected loss. And not only that, but they also reduce the cost of sending their claims adjusters out to examine that loss and organizing the repair operation. So when the consumer or the homeowner takes all of that loss on themselves, then that can dramatically reduce the price of the policy. So one of the ways that insurers have tried to reduce the face value of their policies is to slowly ratchet deductibles up so the premiums remain relatively constant, or at least they don't rise as quickly. So what I've seen happen more and more often now is that deductibles, rather than being a stated $1,000, might be 0.5% of replacement costs, or even as high as 1% of replacement costs. And a more naive consumer might not recognize the full impact of that, find themselves with a fairly large loss due to a roof replacement, and then realize that a significant amount of that was not covered that they expected to be covered, and that would potentially generate a surprise. And then we also recognize that when a natural disaster happens, price gouging tends to happen as well. And there's a school of economics that suggests that price gouging isn't necessarily a bad thing because it allows suppliers to allocate goods to the people who need them most. But in any case, when consumers are subject to price gouging in the wake of a natural disaster, or simply the supply of labor falls for people who can actually do the repairs, that may cause repair costs to spike to get the work done more quickly. And that could also generate a potential coverage gap that the consumers may not be prepared for. Again, this is from Jay Feynman as well. The rest of the presentation is original to me with some other outside resources, but these first couple of slides came from Professor Feynman were, I thought, particularly useful in the way he organized them. The next area I'd like to look at is liability limits and how they impact uninsured and underinsured motorist coverage, which I think for most people who start thinking about buying auto insurance, this is an area that they really, eyes tend to glaze over. Whenever I talk to an insurance agent on the phone and my wife is nearby listening, she's sort of amazed that anyone would have that level of enjoyment of buying an insurance policy. I do because I understand all these things, but I also know that it's a particularly frustrating experience for a lot of people because a lot of these things just don't make any sense to them. And furthermore, we always hope that insurance is a product that we buy that we never actually have to use. But liability limits are fairly low in most states. Ranging between $10,000 and $30,000 per person involved in an accident to $30,000 to $50,000 per accident. Those are the kinds of limits that vary from state to state. Of course, some states have personal injury protection and no-fault laws that can change those limits somewhat. But those are the types of limits that we have in place. Most accidents have bodily injury that falls below these limits. So if you have a little fender bender and the person in the other vehicle has to go to the doctor's office, you may end up with a $300 or $400 claim well below those lines. However, major accidents where an ambulance is called can quickly exceed these limits. So I talked to my students in class about what happens if you find yourself in an accident where the person who hits you has a $10,000 limit per person. Say, well, what's going to happen is that the ambulance will be called if necessary, and as soon as the ambulance is called, we've incurred our first $2,000 expense. The accident victim is taken to the... Heather says that we're having some audio difficulties, so I'll hold for a second.
Jim, are you able to hear me? It's Frank Tomasello.
I'm testing. I'm back online. Our hosts are calling back in to make sure that we have full audio access.
This is Frank Tomasello, having just dialed back in. I hope that I'm audible.
But I don't hear anything.
Heather, can you hear us now?
Okay, there you go. So I'm sorry about that. James, if you want to go ahead and keep talking.
Okay, I'm talking. You want me to continue with the presentation now?
Yes, please.
Okay. Let me step back just a couple bullet points here. Auto liability limits in most states are fairly low, between $10,000 and $30,000 at a minimum per person, and $30,000 to $50,000 per accident. Now, as I tell my students, now I'm going backwards. There we go. As I tell my students, most accidents will fall below these limits, so that a person who is injured in an accident who needs to just go to the doctor's office and get something checked out might be $300 or $400. But as soon as an accident becomes major and the ambulance is called, then those costs begin to escalate very quickly. If we have to call an ambulance, then we're suddenly up to $2,000 in damages that will be due to the ambulance company. And then we're admitted to the emergency department, which will typically be at least $1,000 more. Now we're at $3,000. And if we have to go to the emergency department, we'll typically be out of work for a couple days. And those lost wages will also be the responsibility of the tortfeasor or the person who caused the accident. Now you can see how once if we have serious injuries or even fatalities, we now are in the place where we can quickly exceed those per person injury limits. A lot of people don't realize this, and they also don't realize how many people are driving with how many people are driving around them who are insured at this level, or perhaps even uninsured. In fact, the Insurance Information Institute says that between 13 and 15% of drivers are totally uninsured, which means that in most states they're driving illegally. So with that in context, people may choose to reject uninsured, underinsured motorist coverage when it's available and not required. If they are rejecting that coverage, they may find themselves faced with an accident where they are incurring expenses for which they have standing to sue the tortfeasor or the person who caused the accident, but may not recover anything because that person is actually judgment-proof, having absolutely no assets to cover the losses. It's also important to note that the standard homeowners coverage limits for bodily injury that happen on site, like slips and falls, or even personal liability injury associated with someone walking their dog and the dog injures someone, those limits tend to top out at $300,000. So there's actually a huge opportunity for insurance companies to provide umbrella policies, which are actually relatively inexpensive, but very few people take them up. Now, part of the reason few people take them up is that an umbrella policy that covers losses above those limits usually requires a more substantial underlying auto liability policy with limits more like $250,000 per person and $500,000 per accident. But there's a gap there that many, we would call an unknown unknown, that many people aren't aware of the type of loss that they could incur. Let's go now to a coverage gap for cyber threats. Now, if you take a look at the chart that's on the screen, this chart shows the growing incidence of data breaches and identity thefts, and this comes from the Identity Theft Resource Center. Given the fact that we have this growing level of identity theft, both in terms of records exposed, and you can see from 2016 to 2018 that number went up by about 12 times, and then the number of data breaches also increasing over time with a slight drop in 2018, that gives us a very strong clue that many people have their identity exposed and therefore may have a difficult time recovering the losses associated with an identity theft incident. Laws limit credit card damages to the stated amounts of loss. That is, if someone steals my credit card number and then goes out and buys a $400 suit with that credit card, then the credit card company will take care of the damage associated with that. They will cover it, and I pay for that in part with some of my annual fees. And if I don't pay my bills online, bills on time, I pay a higher interest rate to cover that potential risk. But what the credit card companies will not cover is the cost of addressing a credit repair. And the cost of credit repair is also typically not included in a personal homeowner's policy, and many individuals are not aware of this. And they also aren't aware that many carriers also provide the coverage for identity theft repair with a fairly small deductible and a really small premium. If more people were aware of that, then they might take up the opportunity to buy that coverage to help them in incidents where their identity is stolen.
Jim, apologies, from a risk management perspective, I wonder, are there other ways that folks might sort of go about either protecting themselves or perhaps mitigating issues from identity theft?
Yeah, that's a good question. Obviously, carrying few credit cards with you so that there's less opportunity to lose them, and maintaining a list in a separate place of your credit card numbers and the phone numbers to call as soon as you realize that a card is lost. Monitoring your credit report on a regular basis, or signing up for the free services that send you a message when there's been a change to your credit score. All of those things are things that people can do, but even when you do all of those things, there are still some holes that are left. And I think that the growing level of cyber threat and the number of data elements that are exposed when manufacturers and retailers have their data sets exposed, these are areas that will never completely cover those costs and those risks.
Thank you, Jim.
I'm going to move on to a protection gap now, which relates to home-based businesses. Typically, business equipment that is used in the course of doing business is covered up to $2,500 under a standard homeowner's policy, but that coverage is limited also by a deductible that has to be met before that. So anyone who has business equipment, whether that's a press for a T-shirt or a copier or computer equipment at home to operate their business, might not realize how much of that could be not covered when they have a loss, a fire, or a theft, or some sort of breakdown. In addition, when a home business requires visitors to come to the home frequently, there may be limits to the amount of bodily injury on premises that are covered. Now, if you're an artist and you're running a home-based business and somebody pops into your house every 3 or 4 weeks, that may not be a significant issue. But if you're running an in-home daycare and you're not carrying additional business owner's liability coverage, you may find yourself in a situation where there is not coverage for a liability that you thought there was coverage for. So there are in-home business and business owners policies that can expand the coverage based on needs, but our constituents need to know about these policies so they can take advantage of them. And then finally, policyholders need to verify whether their personal auto policy extends to the use of their vehicle in the course of doing business. If it can be found that a person's involved in an accident while they're engaged in a business, the standard automobile policy may exclude that particular claim. Again, you have to read the insurance policy to know for sure, but it's an area where there's a potential gap for a policyholder. Moving on to another type of home-based business, which is the growing incidence of renting out a room or two in your home, or even your whole home, in a time when there is an opportunity to earn some money from that. You might encourage a constituent to go and look at what that Homeshare host company, whether it's Airbnb or VRBO or a group like that, see what they provide in terms of liability insurance. What they will show is that they typically provide liability insurance with a $1 million limit per occurrence, and that covers liability for certain incidents of a person who's injured while they're in the home. However, it's important to note that this insurance only extends liability coverage, and it is not property damage coverage. So any damage that's caused by the guest or the customer may not be covered by that person's property damage policy. Now, you'll also note that certain providers of the service, the networks like Airbnb, provide a host guarantee coverage, but that's not insurance. It's a promise by the company to cover property damage, and typically if it's more than a minor issue, it can be a real challenge to get coverage for that. So people who are renting out their homes or portions of their homes need to look into a type of Homeshare host policy that would be provided by their insurance company at an additional cost so that they can fill that protection gap. The next category is fairly similar to that, which is rideshare coverage. Now, rideshare coverage has gotten some press because there have been incidents where people have liability exposures that they weren't aware of until they run into an incident. So it's important to note that most personal auto insurance policies exclude coverage while carrying passengers for hire. Now, I remember when I used to commute with some friends to baseball games, we would help each other out with gas, and we'd joke about whether this was a hired job or not. Of course, that doesn't typically qualify as a hired job, but picking up someone using an app to take them to their destination could be considered a hired job. The coverage for these policies, the hired job begins when the Rideshare app is turned on. So once the Rideshare app is turned on, then the driver becomes covered by the insurance policy on a primary basis, which means that the network's insurance policy is the first to cover. And then it provides coverage from the time a fare is accepted, and the drivers need to know what the coverage level is for that particular policy. But when the driver is in a vehicle waiting for a fare, when the app is turned on but there's not yet a rider in the vehicle, they may be subject to liability that they're not covered for by their personal auto insurance policy. And this provides a protection gap as well. Now, it's not a hard gap to fill, but for a relatively small cost, most auto insurance carriers will add an endorsement for rideshare coverage. It's important to know that it's available, but unless the agent knows that the person is using their vehicle as a source of extra income in rideshare, they may not know to offer that coverage. Therefore, it becomes an unknown unknown. Going on to the next category for natural disasters. Now, we've already talked about flood and earthquake being excluded under standard policies, and there are state and federal insurance programs that will cover those coverage gaps. People who live in those areas tend to know about those, but they may not always know about them. However, once a natural disaster hits, and we see this most recently in California where the wildfires have become more extreme and more frequent, the insurance suddenly becomes unavailable following a natural disaster. It's not unlike after September 11th when terrorism coverage suddenly became unavailable because it was no longer considered an insurable risk. So what happens within the insurance industry is that if the person has a brand new policy, within 60 days of writing that policy, the insurance company can cancel them for any reason. When we moved into our home, we had a water problem that would have typically been covered under an insurance policy, but after looking at the policy, we realized that the insurance company had the right to cancel us, and we were not in a position to make what would have been a relatively small claim and then be canceled. That wasn't a natural disaster, but it's an example of how insurance companies have the broad right to cancel within 60 days. Then insurers can also non-renew policies with 45 days notice and a specific cause. That is to say that if the policy is coming up for renewal, a month and a half before that renewal date, the insurer can send a letter to the policyholder saying, we are not going to renew your policy. You have no recourse for this, but here's the reason why we're not going to renew it. And when that happens, then it may be very difficult to go out and find another policy because typically all of the insurance carriers in the area are scaling back on the amount of coverage they're providing in that very high risk area, or they may be increasing premiums so substantially that they no longer become economically appealing. So some states in the Gulf Coast, there are several states that have put in their own windstorm plans as a response to rising insurance premiums after windstorms that are state funded. And California has put together the FAIR plan, which is a plan that provides only property damage coverage, which now means that the policyholder may need to go out and seek a liability-only policy so that they have coverage for their personal liability issues while looking to the state to provide a property damage policy. And that could be a problem too, because if people think that they are getting a homeowner's policy from the state, not realizing that liability is excluded, they might find themselves in a position where they have a significant coverage gap. Now for the last area, we're looking at a protection gap here. Oh, I've got some bullet points in the wrong order. Just give me just a second. What is not here is that employers are required to pay for injuries to their employees that occur while on the job regardless of fault. That's supposed to be bullet point number 1 that is missing. That's a part of a grand bargain that was made between employers and owners and legislators back in the turn of the 20th century that allowed employees to get coverage and compensation for injuries that occurred while at work regardless of fault, but also, for the most part, exempted employers from being sued for general damages like pain and suffering. So it provides broad coverage for employees while limiting the potential tort obligations for employers. Now, what's important to know, and many people don't think about this, is that household employees like housekeepers and child and elder care providers are often eligible for workers' compensation insurance. It's different from state to state. Every state has a different qualification for who is eligible and a different responsibility for how the homeowner can satisfy that obligation. But it's typically not covered by the standard homeowner's policy. Oh, there's that first bullet point. And because it's not covered by the standard homeowner's policy, that means that an additional policy may be required, a workers' compensation type policy that will bring along with it coverage for those types of accidents and injuries that can happen at work, including industrial illness or illness that comes from ingesting fumes or food poisoning or things like that while the person is on the job. So that is a way that we can fill the domestic employee gap. Of course, you've also seen, if you follow politics at all, which most of our audience members would, that people are often caught with failing to pay for taxes for domestic employees, payroll taxes that are due. And so that's another area where people who have home-based employees find themselves at issue. This can also come into play when you hire a contractor to do work on your home and that contractor has employees. It's important for people to, and most people wouldn't know to do this, it's important for people to obtain a certificate of insurance to demonstrate that the contractor actually is purchasing workers' compensation for their employees so that the homeowner doesn't somehow become responsible for injuries that happen while contractors and subcontractors are on site. So that brings us to the conclusion of the points that I had identified as potential protection gaps in the insurance industry, primarily focused on property and casualty insurance in the personal lines market. And a lot of these can be expanded to other lines of business. We might find that there are protection gaps within life insurance with respect to mental health issues and suicide and things like that. We can find that there are protection gaps in medical insurance and prescription insurance where things that we thought would be covered are not. Under the Affordable Care Act, there is some protection there, but it's not always clear and can change from state to state as well. So let me conclude by identifying that many consumers are unaware of coverage gaps. They have unknown unknowns within their policies and their coverages, which leave them exposed to potential loss that they are not aware of. Policies and other risk management tools are often available, but if the constituent does not know that the opportunity is there, then they may not have the opportunity to buy that coverage and will remain uncovered. Agents, when agents are used, can often be helpful in addressing these gaps, but many, many more people are going online to buy their insurance policy from some sort of artificial intelligence agent that may not be programmed to ask the kind of questions that need to be asked to determine whether the person is exposed in such ways. And the challenge is to find ways that we can make constituents aware of the unknown unknowns. And that's something that I think that legislators will have as part of their agendas going forward, is determining not only ways to make sure that the unknown unknowns become known knowns, but that they don't remain as known unknowns where we don't know how they're going to pay for them. That's my conclusion, and I would open the floor for questions through the audience chat or otherwise.
Jim, thank you very much. Very informative session. In the time that remains, let's pose a few questions for your reaction. To begin, of the unknown unknowns that you spoke of earlier in the program, which do you believe are the most significant from the perspective of societal impact today in 2019?
From societal impact, where it affects the largest number of people, I would be looking at liability limits, insured value, and cyber threats as the three biggest that affect everyone. I think that the lack of awareness about what is covered and not covered by liability policies and the number of uninsured drivers, when I started looking into that, I was pretty stunned, and then I immediately called my agent and increased my underinsured motorist coverage. The liability limits are important to recognize. Other areas are either more specific to individuals who are pursuing certain types of business or people who live in particular disaster-prone areas of the country. So if I say, for example, home-based business, home host, rideshare, those are really focused on people who are earning a living through what we might know as the gig economy now rather than the standard lines of business. And if I look at wildfire, that's become an area that is particularly important for people who live in wildfire-prone areas. But we know that with climate change becoming more evident and the impacts of climate change bearing down on our properties, we just don't know where the next area where a disaster is going to happen that's going to open up issues associated with non-renewability.
Thank you, Jim. Greatly appreciate your reaction there. To follow up with respect to uninsured and underinsured motorist issues, the percentages you shared a bit earlier in the program, I assume, are nationwide percentages. So
yes.
Sort of a compound question for you. Is that correct? And are there certain states that face particularly significant challenges there in terms of uninsured or underinsured motorists? And if so, can you speak a little bit to that, those dynamics here in our country?
It does vary. I'm looking up some stats right now. Give me just a second. It does vary by state. The numbers I mentioned were national numbers. It does vary by state, and some states have as many as 20% of their drivers are driving uninsured. In Florida, it's estimated to be 27%. Mississippi, 24%. New Mexico and Michigan and Tennessee all right around 20%. And so that's a really significant problem in those areas. I grew up in a part of Pennsylvania where the liability limits were somewhat high. The minimum liability limits were somewhat high, and it was interesting to me where I grew up that there were a lot of people driving around with Ohio license plates because the Ohio limits when I was younger were much lower than the Pennsylvania limits. So it's also important to look at the minimum limits in the states that surround you to understand what the underinsured motorist population is. And that's a much harder number to get to, right? Because what qualifies as underinsured in one state may not be the same in another, depending on the tort laws in that state and the no-fault laws. So that's it really is something that varies from state to state on the underinsured side, but a strong awareness of what the potential opportunities are to make sure that you are covered when someone else hurts you and is not capable of helping you out or taking care of their obligations is pretty important.
Jim, thank you. To switch gears a bit here, as it were, given the rise of the gig economy, do you foresee increased home-based business protection gap issues? Now, you spoke a bit about those earlier in the program. And are you aware of any efforts to proactively address needs in that area?
So the first part of your question, do I anticipate more gaps? I do. Until the self-employed network employment opportunities, which I guess would another way to put the gig economy, until either the providers of the networks, the Uber and the Airbnb and companies like that, expand their coverage to attract more members of their network, or the size of the networks becomes so big that they become standard portions of the policy, I think we will continue to see those coverage gaps. And I think it becomes it may not be something that the network providers want to do, but they may need to insist that their drivers carry their own insurance for times when they're not protected, or at least make them fully aware of the potential obligation that they put themselves under. As far as what can be done about it and what's being done about it, I'm not aware of any efforts, but I'm not as plugged into that particular space. If I were an Uber driver, I'm sure I would be.
Thanks, Jim. Some may have been surprised to hear that 3 out of 5 homes are underinsured by at least 20%. Can you offer some additional insight into why this sort of dynamic exists at that level?
Yes. One of my favorite academic papers I've ever read is a paper by Samuelson and Zeckhauser, and it talks about the inertia bias in purchasing insurance. I sort of joked earlier about the fact that I love to buy insurance and I can spend hours on the phone with agents asking all the questions, and I really enjoy it. But I know that makes me a very unique individual in this society. for most people, the problem that they face when they're purchasing insurance is one that they don't want to face any more often than they have to. And even the idea of trying to estimate what their home is worth, unless they're recently in the real estate market or they're looking at entering the real estate market, they may not even know what it would cost to move into another home similar to theirs following a natural disaster or a total loss of their home. So unless people are in the process of renewing their policies actively every year or 2 years, it's very likely that the value of their home outruns the replacement cost that's stated in their policy. Now, one thing that could be done to change that is to adjust the standard policy so that they have an escalation clause that follows some sort of real estate inflation index. But I'm not sure that the state regulators are yet on board for approving policies like that across the board, nor insisting that those kinds of policies would be made available.
Thanks, Jim. We are nearly out of time. I will pose a final question for your reaction. You talked a bit earlier of fair plan coverage in California, a state that is certainly no stranger to natural disasters. Are other states providing residual market for home insurance? And can you talk a little bit about sort of how wide a practice that may be, if indeed it is?
Yes, it is. Most of the Gulf states, Florida, Alabama, Mississippi, I think Louisiana, provide some sort of residual market as well for homeowners coverage. And those are a little bit more mature than the California market because they've, of course, been battered by windstorms for a longer period of time, although most of the evidence is pointing to the fact that windstorms are becoming both more prominent in number and severity. So it's really become important for that residual market to take up the slack. However, in many ways, the residual markets, you might say, are continuing to leave the risk underpriced, really encouraging people to buy beachfront properties without concern for total loss, realizing that there's a pretty good state-based safety net that will help them out. There's no other way to explain the fact that people continue to build on the Carolina coast every 3 years.
Thank you very much, Jim. We are up against our 60-minute deadline, so we'll conclude our conversation out of respect for the time of all of our attendees. Let me take a moment to again thank Dr. James Hilliard, Associate Professor of Instruction in the Department of Risk, Insurance, and Healthcare Management at the Fox School of Business at Temple University. We greatly appreciate you sharing your insights with us today. Our hope is that participants will be able to join Dr. Hilliard on site at NCSL's Capitol Forum in Phoenix, Arizona on December 12th. I imagine that our friends at NCSL will speak to that in just a moment or two. Also want to take a moment to thank all who attended today's webinar and those who submitted questions for discussion. And of course, a special thanks to Heather Morton and all of our friends at NCSL with whom we've collaborated on the session. I'm Frank Tomasello. Thanks very much. I will turn things over now to Heather for some closing comments.
Thank you to Frank and to Professor Hilliard for presenting in today's webinar. And we thank each of you for participating. As Frank mentioned, we will be having a session at the upcoming NCSL Capitol Forum that will be sponsored by the Insurance Task Force. And there will be a lunch and learn, so you'll get lunch if you come to the session. As a reminder, please complete the webinar survey. There may be a short delay before the survey actually appears up on your screen, just as a fair warning. And definitely, if you have any additional questions after the webinar, please do not hesitate to contact me directly. You can reach me through email at heather.morton, and that's MORTON @ncsl.org, and you'll see also that my email address is listed on the screen. Thank you so much for today, and we look forward to seeing you in the future.